Shall we start? Yes, music is off. Okay. So hello, everyone. Thank you for being here in the room with us. We have a few people in the room. There are still many seats. So if anyone is out there online and is not far from the conference center, please join us. We have about 100 seats available. But thank you very much, everyone, for joining. I see that we have over 125 colleagues joining us online, and we look forward to these sessions this morning and then in the afternoon for those who are close to retiring or separating, to go into more practical details in the afternoon that are relevant for anyone separating soon. So today we're here from the UN Pension Fund. We are 3 representatives. On my left, Mercedes Burguete, who works in the fund's Geneva office and is a pension expert in Geneva. And on my right is Dilba Muradova, who is a pension expert in the fund in New York. And I'm also coming from the New York office. So we are here at the invitation of UNICEF, who very kindly organized this room and this session and coordinated together with UNHCR to ensure that all UN offices in Panama have access to this session on pension. And we are very happy to see that there is a significant attendance, because we do hope that through this pension information session, you will feel much better equipped to navigate pension questions, to know where to find information when you need it, and just simply have an understanding of what your current status is as a participant, but then very importantly, how you earn your future pension rights and what your options will be in the future when you separate. So we are hoping that we can make this a little bit interactive. I know we are not many people here in this room, but please, for those who are here in the room, feel free to raise your hand and ask questions if you find something is not clear, or if you have questions that are specific to a certain topic. It makes the session that much more interesting, rather than just seeing slide after slide and listening to me exposing you to pension information. To those of you online, please use the Q&A, which is in the top, not exactly right corner, but you have a Q&A with a little question mark. If you click there, you'll see that you can submit written questions. So we know that you can't obviously switch on the microphone or your camera, so you won't be able to take the floor. However, you can submit your written questions, and both Mercedes and Dilba are going to constantly monitor your questions. And if they feel there is something that is of interest to everyone, they will let us know and they will raise the question aloud. so that we can address the question and not just follow the PowerPoint. So use the Q&A, ask questions when you have them, so that we can really make sure that you get the most out of this pension session. And very importantly, we have Mercedes, who is Spanish and obviously fluent in Spanish, and who is very happy to answer questions in Spanish. And obviously you can submit your questions in writing or here in the room in Spanish if you feel more comfortable asking that. And Mercedes will answer in Spanish. So with that, anything that we should add? No? Mm-hmm. All right. So we have this presentation, which we will share with the organizers, and they will share in turn with everyone. So it'll take maybe a couple of days for you to get the presentation, but you'll have it and you can use it as a reference document in the future to go back to verify some of the things that we talked about today, or even just have it in future so that you know when the time comes what your benefit options are and so on. This being said, I think the most useful tool to get information about pension is the website, the pension fund website. And I will, throughout the session, use the website time and again to show you where you can find relevant information for certain topics. Another very important tool is your member self-service, the UN Pension Fund member self-service. If you have not yet registered for access to the pension fund member self-service, I would very strongly encourage you to do that, because there is information actually already now that while you are participants, you are still active staff, that will give you important information about your status with the UN Pension Fund. One of those documents is the annual pension statement. That annual pension statement has all the information important for you to know your current status with the fund, to have from the beginning of your participation in the fund till the most recent prior year end, the years that you contributed, years and months, the total amount of money that you paid into the pension fund out of your salary, plus the interest you earned. You'll also see your pensionable remuneration, and I will explain in a little bit what that is and why it is very important to determine your contributions to the fund, but also your future retirement entitlements if you are going to receive a retirement benefit from the fund. So that annual statement is published every year in your member self-service around the middle end of May. And it always goes till the most recent prior year end. So currently you can access your 2022 pension statement, which again includes all the information about your pension account since you joined the pension fund till year end 2022. Anything that is going on in 2023 will be reported to us by your organizations year-end 2023, and then our records will be updated by May 2024. So that pension statement is a very useful tool, and maybe some of you printed it out and brought it along. If you did, great. If you didn't, that's fine too. Another very important tool, I think, in member self-service is your estimate tool. And there you can run estimates as often as you wish for whichever separation date you may consider as your end of career. So that estimate is open to everyone who is currently a member in the fund and who joined within the last, I think since this year. So if you joined even very recently, you probably already have access to the MSS and of course all the tools. You may not yet see a pension statement you will not see a pension statement if you joined in 2023, obviously, but otherwise you have access to all the tools that are available. So the estimate tool is good for those that are approaching separation and retirement, not only, but especially. No one really should make a benefit election before having obtained an estimate. So I would very strongly encourage anyone who is getting close to separation or who is considering retirement, maybe even early retirement, to go and run an estimate, to be aware of what your benefit options are and what the amounts are per option. And if you have questions about your estimates, if they are general, I hope we address them today in this session or this afternoon. And if there are still questions remaining, we can see if we can organize a Q&A session tomorrow where we can take some of the questions, but that would be an in-person session only. So we can see if there's some interest for that. Hello, welcome. So with this, I just wanted to start with sharing my PowerPoint, and very quickly we will show you a video. So let me just share. Oh, sorry, I have to first go into website. I don't know what you see. So in PowerPoint mode. Okay. All right. I hope you can see. Yes, you can. All right. There might be a slight delay between what you see here in the room and our colleagues seeing online. Can you see? Okay. So this is what we're going to cover today. Some information about the pension fund. Without going into nitty-gritty detail of how the fund works and how we do everything, we would like you to have a bit of an understanding of your pension fund. So we will give you a little bit of an overview, how it works, what kind of pension scheme you are part of. That's important because it's actually a very good pension scheme, a defined benefit scheme. A little bit financial information, and then we go into more, let's say, regulation and rule related information, which is about your current status in the fund as a participant, what your options may be if you joined fairly recently, but also general information that is relevant for every participant until separation, about breaks in service, about special leave without pay, and whatever may pertain to participation. We will look at the key factors that are used to determine future entitlements from the fund, so that you understand how the length of you contributing to the fund translates into your future entitlement, or how your age will impact your benefit options, or how the length of your contributory service could impact a so-called reduction factor if you were to elect early retirement, etc. So we will look at these factors that determine your future entitlement, so you understand how we actually arrive at the amount that you are entitled to in the future. Don't worry, for those of you that are like me, that are not necessarily very math-driven, it won't go into calculation details and so on. It's really just to give you an idea of the concept of how do we derive pension entitlements. We'll give you some explanations of certain terms that we use in the pension fund that are pension language, and that will make it easier for you to understand and navigate the pension website and generally pension information in your annual statement, etc. So if you hear something like pensionable remuneration, you don't say, I have no idea what that is, as I did before I joined the pension fund, but you understand that that is, for example, a scale of your income used to determine your contributions to the fund and your future entitlements. And then we look at the actual benefit options or the benefits that the fund pays. There are very many benefit options, well, not many, but there are several benefit options. And depending on the length of your contributory service and your age when you separate, you will have certain options to choose from. And then we will look at the actual benefits so that you know, well, if I wait and I reach normal retirement age or beyond, I'm entitled to a normal retirement benefit. What does that actually mean? Can I get a lump sum? Will there be survivor's benefits included in a retirement benefit? Will I get a child's allowance if I have a young child, etc.? So we look benefit per benefit at what does each of these benefits actually provide. So we will look at the withdrawal settlement, at the different kinds of retirement benefits, and we'll also have a look at something that is not a benefit, but an option or an arrangement, which is called the option to defer your benefit election and or the payout of your entitlement. You could call it a freeze option, where you can leave your money in the fund after separation and see whether you will join another organization in the near future. You'll understand once we talk about it. And then we'll give you just a very high overview of the calculation of benefits, so you understand it's really not rocket science at all, so that you understand, what is the basis of my entitlement. And we will also talk about the different survivors' benefits. The survivor. Sorry, we had a little audio issue. Does it work? Good, great, thank you. So we'll look at the different survivors' benefits and also what we call a residual settlement, which is basically the payment the fund might make in the event that someone dies and that there are no survivors entitled to regular monthly survivors' benefit payments, if there is a residual of your own contributions. So we will, of course, explain that in much more detail once we get there. And then we'll talk about separation from service. And in the afternoon, we'll go into the practical details of the separation process in quite some detail, how you can track receipt of separation documents by the fund so you know where in the process your case currently is if you're separating. In the afternoon, we will talk about payment options. We will talk about retirement essentials, so information that is key for retirees about things they have to do while in retirement, etc. So the afternoon is really focused on information that is very relevant to those actually retired or actually retiring or separating. But in the morning, we will cover those aspects that I just explained. And then finally, and we'll actually weave that in throughout the presentation, we will show you where on the website you can find relevant information so that you can use the website as much as possible whenever you need it and know where to find info, so that you know how to contact the UN Pension Fund. There are various channels to contact us. We have a call center, we have an online contact form, so we'll take you through those steps. And we will show you a little more detail about member self-service, how it can be used as a participant. But also this afternoon, we will talk to you about how you will be able to use member self-service as a future retiree, if that is the case for some of you. All right, so this is really what we will cover. So we better get started, given that we don't have that much time left. Can I make this small? Yes. Okay. So first of all, who are we? This pension fund that probably for many is very abstract. We actually have an office, obviously, in New York. We have an office in Geneva, and we have two very small offices, one in Bangkok and one in Nairobi, covering regionally pension outreach. The Bangkok and Nairobi offices are 1 or 2 people. They are very tiny. They really are focusing on what we do here today, outreach in the region and in the location. And they also meet with clients locally in the location. That's the focus of what they do, given they are 1/2 people. So Geneva and New York are the main offices of the fund, where we actually process cases, where we handle enrollment to closing of a file at the end of someone's lifetime. Also, in New York, we have the investment office of the fund, where all the assets of the fund are being managed. So the pension fund works in a certain way, and I would like to share a video that we created to give you an overview of how the fund works. This is also to encourage you to actually visit our website and the different videos we have, because we have over 20 videos that were created, each video being just a few minutes, were created to make information easily accessible and understandable. All these videos exist in English, French, and Spanish. The fund's official languages are English and French, but for information documents where we can, we do create them in Spanish, knowing that we have a quite large population of participants and members in the fund who speak Spanish. So I will show you that video now, and I'm moving to the website. I hope it works in the way that I intend. So here I'm on the website, and to get to the videos, I go to resources, and there we have all videos. I'll show you more of the website as we go along. But for now, here is the video, and there is a welcome to the fund video, which we are going to skip. And there is the how the fund works. And this is just really to give you a bit of an understanding on the fund. I hope the audio works. Oh, I switched off the audio. Hold on. I think I have to do one change. If you can't hear the video, especially online, please let us know in the chat so that we can fix it, or we have to skip the video. We don't hear it. Hold on, I have to change something. I'm apologizing. Okay, I'll try again. Switch this off. How do you switch it off? No, I need it off because the video is on the computer. All right, I'll try again. Try again. It doesn't work. You can't hear it, right? No. I hear it. Okay. Yes. I'm stopping it because there's no sound for anyone. Sorry for that. So we skip all the videos. Yeah, so I need the video as a microphone back. All right. Oh, okay. Okay. So sorry for that. Oh, sorry. Okay, we're learning. Hybrid is hybrid is more complicated than just online. So sorry, because in the end, I know in the room you didn't hear anything, and then apparently online you didn't hear anything. So I'm sorry, I'm not sure about the setup, but I'm just going to skip the video. You got a little bit of visuals, so you know it's out there, and maybe this will encourage you to go and watch these videos. I will then just present what is in the video myself, and that's just as well. So I have to go back to share my presentation. Sorry for all of this. We'll get there. All right, back. So skipping video about the fund. So basically what the fund, sorry. It's good, okay. What the video was telling you is that the purpose of the fund is to provide for income replacement in retirement, of course, for those who reach the entitlement to a retirement benefit. And that in order to receive a retirement benefit, you need to contribute for a certain duration in time to the fund, 5 years or more. And once you have contributed to the fund for at least 5 years, you have vested your pension rights, meaning you then have earned the right to a form of lifelong retirement benefit if you are interested to get one. Some people have that right, but still opt to get a so-called withdrawal settlement when they separate because they, for personal reasons, prefer to have a one-time cash payout. But the purpose of the fund really is to provide for this income replacement in retirement, as well as, and that is very important, to cover the risk of disability and death for anyone who is a member in the pension fund. And that coverage for disability and death exists from the moment you join the fund. There's no vesting required. You don't have to contribute for a minimum duration. The moment you become a member of the pension fund, you are covered for this risk. The only condition you must fulfill is that you were medically cleared when you joined your employing organization. That is the case, I want to say, for probably 99% of the staff joining UN pension fund member organizations. So for as long as you were medically cleared, you are then, the moment you join the pension fund, covered for the risk of disability and death. What does that mean? It means that if for reasons of health, you can no longer work, you had extended periods of sick leave, and at the end of exhausting all of your leave entitlements, sick leave, certified, uncertified, on full pay, on half pay, and also all your annual leave, if your illness remains or your medical situation continues, then you might be entitled to get a so-called disability benefit awarded. There's a certain process to apply for a disability benefit, but if it is awarded, then the fund takes over to pay that income replacement in the form of a disability benefit. So we have a staff who can no longer earn an income and can't provide for their own and maybe their family's needs. So that's where the fund comes in and covers this loss of income by providing a disability benefit. It's a very important coverage. We have pay several thousand disability benefits every year. And that coverage of disability is a monthly payment, just like a retirement benefit. And it is payable for as long as a person is disabled and confirmed through medical reports from time to time that the disability continues. The other coverage for death is that if someone dies in service, the fund would take over to provide for surviving spouses and children's benefits as applicable for the survivors. So again, this idea of providing for income replacement when a member of the fund can no longer provide that income, in this case, because of death in service. So at that point, of course, survivors need to qualify. For example, a spouse must be married to our pension fund member and participant at the time that they are a participant. If they were married at the time of our participant's death in service, the spouse is normally entitled to a lifelong surviving spouse's payment. Every month, they will receive for life a surviving spouse's benefit. That would be 50% of the value of the deceased staff member's theoretic retirement benefit. So if I died today, I'm 52, I'm 10 years younger than my normal retirement age. My husband would be entitled to a lifelong surviving spouse's benefit at the rate of 50% of what my retirement benefit would be if I continued to pay into the fund till 62. So in spite of me having died, the fund calculates the entitlement of my spouse as 50% of my theoretical retirement benefit, normal retirement benefit. And the same if someone dies very young after, saying, 6 months contributing to the fund and dies in a car accident at age 22 and maybe survived by a spouse and 2 children, the fund will take over and pay that spouse a lifelong surviving spouse's benefit based on what would have been that person's retirement benefit had they contributed up to age 65 to the fund at the rate of their current grade and step at the time of death in service. So I think you get the idea. It's a very generous coverage, very important coverage that we all have just by being members in the UN Pension Fund. And that coverage is possible because the organizational contributions, there's one share we pay. We, the participants, pay contributions to the fund every month, as you all know. The organization that we work for pays twice that amount every month on our behalf into the pension fund. That money that the organizations pay remains in the fund to yield assets. So a withdrawal settlement that we pay out never includes the organizational share, because that money it's needed to build the fund and allow for coverage, not only of retirement benefits that are payable for life and include, of course, the calculation includes the organizational share, but the actual money that sits in the fund is needed to kind of grow and continue grow in time so that everyone who is a member in the fund will be covered for this risk of disability and death, and so that we can pay lifelong retirement benefits. So just to clarify, of course, the organizational share is calculated into a future retirement benefit. But it's just that for a withdrawal settlement, we cannot pay out the organizational share because we can't take out that money from the fund every time we pay a withdrawal settlement. I will explain what a withdrawal settlement contains later when we talk about benefits, but I just wanted to connect this here to this coverage of disability and death. So again, for retirement, you have to vest. You have to contribute for at least 5 years to the fund. However, for disability and death coverage, you don't need to vest. And of course, death coverage also exists in retirement. If someone passes away as a retiree, again, we take over to pay entitled surviving spouse and any other entitled person like a child or children, etc. We'll talk about survivors' benefits later, so I will stop here. Now, who do we serve in the fund? All the staff that are qualified to be members in the fund of our 25 member organizations. You here today are members of these 25 member organizations. You are part of what we call the UN family, and maybe some of you are even in some of the agencies that are members of the pension fund. So we have 25 member organizations, and the regulations and rules of the pension fund apply in the exact same manner to every single member in the fund. It doesn't matter whether you work for UNFPA, UNDP, WFP, OMS, UNICEF. You all are covered by the exact same pension regulations and rules. You have your own staff regulations, but you have the same pension regulations across the board of those 25 member organizations. And if you move from one organization to another, most of the times there's no break in service or just a little break in service. It means that you probably just simply continue while a member of a new staff member of a new organization. And instead of UNICEF paying your contributions, now WFP pays your contributions if you move from one to another. So that's who we serve. In terms of numbers, might be of interest to know that the fund has over 230,000 members. So we are over 230,000 members of the UN Pension Fund. Out of those, over 140,000 are staff like you and I and active participants in the fund. So meaning we are the population that are paying contributions into the fund. And in 2021, I'm sorry, I have the 2021 number, but it's similar for 2022. The amount that was paid into the fund by us participants and on our behalf by the member organizations was over $3.12 billion US. Now, on the other hand, we have those in receipt of benefits from the fund. Over 83,000 retirees, survivors, and recipients of disability benefits are members of the pension fund and are so-called retirees and beneficiaries. In 21, we paid over $3.13 billion US of benefits. So you see that the income that we receive from the participant population is not quite enough to pay the payouts in 21 that we had to pay for our beneficiary population. But it's very close. It nearly covers. And that's a normal and healthy trend for a pension fund of the age and the size that the UN pension fund is. Actuaries have predicted this since the inception of the pension fund, that there will be a point when the contributions will be less than the payouts. So it's not a problem. And we look in a moment at the actual funding of the fund, meaning what is the value of assets of the pension fund, which is the pot of money from which we draw the $0.01 billion that we need to fill the gap between the participant income and the beneficiary payout. Just because we all work in client services, we are on the front line of answering questions and queries. To give you an idea of the volume of queries we handle, and we are a group of around 20 people in the UN Pension Fund, plus a call center of 15. We received over 122,000 queries about pension matters in 2022, actually. So that is handled by our team of, let's say, around 30 people. It's a lot, and a lot of these queries are quite complex. So it's not just, you know, like a technical thing that we can quickly fix. We need to review every case in detail, determine the person's contributory service, their normal retirement ages, and so on, and then look at the details of their file to answer the questions. So thank you for being patient. If you write to us and it takes 10, 15 days to get an answer sometimes, that is because we are a very small group of people who handle all those queries, who see walk-in clients, who answer telephone calls, and who do outreach. So all of that, plus we handle what we call workflows. So we process cases to an extent too. And then we have other offices in the fund that handle participation matters, enrollment, anything that is like a processing that is required for participation. We have our entitlement teams. They are implementing benefits, new benefits, thousands every year. That's where they handle the entire review of every case file to make sure everything's in perfect order before they determine the amount payable to a certain person and then set up that payment. And then, of course, we have our financial services where we have a payments team that handles the actual payments, setting them up and making sure they get out, a cashiers team that handles all the interactions with the banks, and then finally an accounts team that does the accounting for the pension fund. So that's what we call our pension administration team. And then on the other hand, we have a so-called investments office, which is a separate team and reports to the Secretary General through a ASG, whereas we in the Pension Administration Office, where we handle individual case files, we report to the General Assembly through our pension board. So that's an idea of who are we in the fund. Those of you soon retiring, I think it might be of interest to know how long does it take the fund on average to implement a benefit. On average, it takes 15 business days from the date of receipt of the complete set of documents required for a given case. So this doesn't mean from the date of separation that you separate from your organization. That would be wonderful, but we depend on you and your organization to first submit documents to us that allow us to calculate and determine your entitlements. So once we have received the complete set of those documents, it then takes an average of 15 business days in the fund to complete a case and implement it into payment. Depending on different organizations, it takes more or less time to receive those documents. For some, it takes 2 weeks. For some, it takes 2 months. I will say that most of the organizations nowadays take not more than 4 weeks to submit the separation documents. And therefore, I would say on average, it doesn't take more than 6 to 8 weeks for someone from the date of separation to receive their first payments. But again, it's entirely out of the fund's control when we receive those separation documents. And at the end of these sessions today, you know what you would have to do to make sure that your documents are in good order and what documents to submit so that there's no delay on your side. But then there is, of course, the HR in your employing organization and the payroll that have to do their due diligence and submit their documents to the fund, a separation personal action and a separation notification document. And only once we have all of that can we then process. And so we have over 93% of the cases being processed within 15 business days. There are a few that take longer because some cases have issues. And these issues could be contribution discrepancies, issues with date of birth not aligning with official documents, etc. It's fairly rare, but when it happens, it can delay processing. And a good point also is that once a benefit is in payment, the fund has never missed a payroll. This seems obvious to you, but it's not all that obvious actually on the payroll side. So we are kind of proud that there has never been a missed payroll, even during times when we change systems or other. So obviously that should be the case. We should never miss a payroll. And normally you can expect once your benefit is in payment to receive it months after months after months without interruption. If there are interruptions, it usually has to do with the individual account. There could be an issue that someone changed account or a bank changed routing format or so on. That does happen sometimes, but generally the fund has never missed a payroll. All right, so the market value of assets of the fund in March 2023 was 81.7 billion. We just looked yesterday, at which date on 15 September 23, the market value was $83 billion US. So you see that just in a few months, the fund earned $2 billion in their asset value. But a few months later, the fund could lose $2 billion. Sorry. So is it normal that there are billion-dollar differences? No. But hundreds of millions? Yes. So if someone follows the fluctuations of the market value of assets of the fund regularly, they would see that it goes like a yo-yo up and down within the hundreds of millions and sometimes 1-2 billion. It's not concerning at all for the investments team or the actuaries of the fund because at the scale of this size, it's totally normal. There have also been big drops in the value of the fund during financial crises. 2008 and 7 was one of those periods the fund lost a third of its assets, but it recovered within 5 years and now is well over the value of that pre-crisis value of the fund. And we have a very steady upward trend of the assets of the fund since its inception. So if you look from the big picture, it's a steady upward trend towards more and more money. But of course, if you look in detail, you'll see that there are waves along the line of fluctuations in the assets of the fund. Why am I telling you this is I, as a participant in the fund, am very interested to know that the fund is doing well, because I want to get a pension from the pension fund in the future. So I want to be sure that when I get there, hopefully in 10 years, I'll get a nice pension like many already do, and some will in the near future. So the fund is extremely financially sound and healthy. We are fully funded, which is very good news. Not every fund is fully funded. And even if we had a deficit, if it's just a small deficit, even that is not a problem, given that we are actually nearly covering our payouts through our income. So with that, the good news is you are part of a very solid, healthy pension fund. And I'm not saying this because I'm here as representing the UN Pension Fund. I'm glad to be able to say it as a member of the UN Pension Fund. All right, so that's about it. I already talked about the fact that we are in Bangkok, Nairobi, Geneva, and New York. We have in total between pension administration and OIM only 400 staff. That is not actually that many people to manage a fund of this size. We do our best. We are constantly working on projects to modernize and simplify things and increase our client service delivery. So hopefully, as time goes along, you will find that we become more and more effective in managing, especially our relations with you, the members in the fund. We are a defined benefit plan. What does that mean? It means that all contribution assets and risks are pooled, which means that we are basically a big pool. You don't hold individual accounts in the pension fund. And once your account is empty, you're done. You don't get anything from the fund anymore. No, you're part of a system where you are entitled to a certain kind of benefit based on a certain number of years of contributory service and your age at the time of separation. So we have a formula that we apply to every single benefit we pay. And if you are entitled to a form of retirement benefit, you will be entitled for life. And the value of that benefit is calculated by the length of your contributory service, which is then transformed into a so-called rate of accumulation, a percentage rate. The longer you contribute, the higher that rate, times your final average income level, your final average remuneration. That is how we calculate your entitlement. So once we have determined your entitlement amount, your entitlement is for life. And if you receive payouts from the fund that exceed what you contributed and what your organization contributed on your behalf, because you live for a long time, over 12, 13 years, which most of our beneficiaries do, then you will start receiving money that no one ever contributed on your behalf. It will come from the big pool of our pension fund. So that is the beauty of a defined benefit scheme. Your benefits are defined based on a formula in the regulations and rules. It's not defined based on how the fund does financially or the contributions you made. It is based on that formula and on your entitlement. So they are guaranteed for life at the rate that you are entitled, and they are adjusted for cost of living over time. So most of our beneficiaries will see that their entitlement increases over time, just like our salaries. So there's a cost of living adjustment part of our entitlement as a beneficiary of the fund. And finally, the pension fund is US dollar based. What does that mean? It means that all the contributions that the fund received are reported in their US dollar value. If you're paid in US dollar, it's obvious to you because you're contributing in US dollar. But if you're paid in local currency, you probably pay in a local currency and see your contributions taken out of your salary in that local currency. Then they are reported to the fund in their US dollar value. So there are fluctuations sometimes due to currency exchange rates. So the fund gets US dollar, and the fund calculates your entitlement, initially the base entitlement, in its US dollar value. And then in the future, at the time of separation, when you tell us, I want my benefit to be paid in, and you tell us the currency in which you want to be paid, pesos of a certain country, euro, France CFA in Africa, whatever it is, you tell us which currency you would like to be paid in, and the fund will then either issue in that currency if it's euro, or transmit the equivalent amount to the US dollar amount, and then have an exchange rate applied so it reaches you in the currency in your account in the way that you asked. So while we are US dollar based, that doesn't mean you can only be paid in US dollar. You can be paid in the currency of your choice. And finally, the adjustments of regular retirement benefits and survivors benefits are normally done based on the movements of the consumer price index of the United States. However, we have a system where someone could ask to go on a so-called two-track or local track and be adjusted over time based on the movements of the consumer price index of their country of residence. I will not talk about that here now, maybe with future retirees later, but normally by default over 80% or nearly 80% of our beneficiaries are all on the so-called US dollar track, where they want to have their benefits adjusted based on the US dollar movements of the consumer price index, even though they don't reside in the US, but in a different country. So that's the system of the pension fund. I'll skip this. It's just a visual illustration. In terms of money, we already talked about the value. I said it's over 83 billion right now. If you're interested in more details on investments, on our website, there's a whole chapter on investments. If you go to the website, I think the second tab is investments. There, if you're interested in that, you have access to a lot of investment related information as well as regular updates on the asset value of the fund. So I won't go there right now, but just so you know, we here are not investment experts. We are from the pension administration side. So if you have questions about that, it would be better if you go and visit that tab. Okay. We are now going to definitions and key factors. So this is just an illustration of the kind of queries that we receive from our membership. And it looks probably a little crazy to you, but for us, this is kind of the life cycle of someone joining the fund till the end of their relationship with the fund. So all of these different stages in someone's participation or relationship with the fund may trigger questions, and we will probably address most of these stages in our presentation today. From you joining the fund, through having options while being a participant to increase your contributory service, to leaving, having a break in service possibly, then coming back, continuing participation, or you leaving and receiving a withdrawal settlement payout, and then coming back and maybe reimbursing that withdrawal settlement to reactivate the contributory service you had before separating, or you leaving and going to another international organization and pension fund and transferring your money from our fund to that fund, or you separating into retirement or into disability, hopefully not into death in service, of course. And then once in retirement, you may have questions relating to retirement, and thereafter, after a retiree's death, there might be survivors entitled to something from the fund. So all of this is part of the subjects that we cover in the fund. So when you join the fund, you have a so-called date of entry into the pension fund. Why is that important? Because that is a date that will determine your normal and early retirement ages. Your date of entry might be different than your colleague's date of entry. Very possible, right? And based on your date of entry, you might have a different normal or early retirement age than a colleague who joined quite a while before you, or a colleague who joins quite a while after you. Sometimes in the existence of the fund, we have made changes to the plan design and changed normal and early retirement ages. It happened in 1990 and again in 2014. There's no plan currently to change anything, but it can happen in the future. That happens because there's increase in life expectancy of the population of the fund. So we have to adjust because the fund will have to pay benefits for a longer and longer period, meaning we have to make sure that actuarially we are still fully funded and sound to be able to pay benefits. So for new entrants, we then start a new date of entry as new normal and early retirement ages. So if you joined the fund in anywhere between 1990 and 2013, 31 December, your normal retirement age is 62 and your early retirement age is 55. If you joined the fund anytime since 1st January 2014, your normal retirement age is 65 and your early retirement age is 58. And those lucky ones that joined the fund before 1990 have a normal retirement age of 60 and early retirement age of 55. There are less and less colleagues who have actually joined the fund before 1990, but if that is the case, it's great because since or as of age 60, you are entitled to a normal retirement age. Can you work beyond your normal retirement age? Of course, if your organization keeps you on and you're allowed to work, and most of us have a mandatory age of separation from our organization, 65, you can of course work up to 65 and some people even beyond. In that case, you continue contributing to the fund, increasing your years of contributory service and therefore increasing your rate of accumulation, which ultimately will probably translate into a higher benefit. I mean, in all likelihood. So yes, you can definitely continue contributing to the fund beyond your normal retirement age. But as of reaching normal retirement age, you could separate and be entitled to a normal retirement benefit without any reduction for so-called early retirement. Because once you reach what we call your normal retirement age based on your date of entry, you are entitled to that benefit. So if you separate at age 61 and your normal retirement age is 60, you are entitled to a normal retirement benefit, even if your mandatory age of separation in the organization is 65. Or in my case, my normal retirement age is 62 because I joined in 2007. If I said I'm going to separate at age 60, I'm not entitled to a normal retirement benefit because I'm younger than 62. But if I separate anytime as of 62, doesn't matter whether it's at 62, 63, 63 and a half, 64, I'm entitled to a normal retirement benefit because I've reached my normal retirement age for pension purposes. So the date of entry into the fund is when you qualify for fund participation, and it's therefore very important. Contributory service, that is the service, the length of you contributing to the pension fund. So you could have periods of non-contributory service while a participant in the fund. For example, if you go on special leave without pay, without making contributions to the fund, you are still a participant in the fund, but not a contributing participant because you didn't choose to pay contributions. So your contributory service is the service when you actually are a member of the fund and paying contributions. And that earns you a rate of accumulation. And that percentage, again, is higher and higher the longer you contribute to the fund. There's a maximum of accumulation rate. So we are now at the third point, rate of accumulation. So again, your rate of accumulation is a direct translation of your contributory service. The contributory service, every month that you contribute, you increase your rate of accumulation by a tiny little percentile. So your rate of accumulation has a maximum accrual rate of 70%. No one can earn a future entitlement of more than 70% of their final average remuneration. how many years would you have to contribute to the fund to hit that maximum 70% rate of accumulation? Over 38 years. So someone who has more than 38, let's say close to 39 years and over, would not further increase their rate of accumulation if they continue contributing to the fund beyond, let's say, 39 years. But if they are a staff member, they will have to continue paying contributions. So you would still continue increasing your own contributions and the interest that you earn on the contributions you make. But you would be capped for your rate of accumulation. This will make more sense later when we talk about benefit calculation. But just for you to know that your rate of accumulation accrues and accrues and accrues while you contribute up to the maximum if you get that far, but most people have a rate of accumulation of less than 50% actually. All right, so this takes us to the pensionable remuneration, which is the other important factor to calculate future entitlements, but also to determine your contributions to the fund. So you contribute money every month to the fund, and you see a certain amount taken out of your salary. How do we determine that amount? By looking at your grade and step, and per grade and step, you have a certain salary scale. We all do, right? Similarly, you have a pensionable remuneration scale. For professionals, that pensionable remuneration scale per grade and step is the exact same wherever a certain grade and step is. So if you're a P3 step 8 in Panama, you have the exact same pensionable remuneration as a P3 step, what did I say, 8 in New York, or a P3 step 8 in Afghanistan, etc., etc. So for professionals, every grade and step has the exact same pensionable remuneration for the same given months, regardless of where the person works. It doesn't matter whether they are single or married, whether they have children or not, whether they work in a danger duty station or not. Same pensionable remuneration across the board for all professional grades and step. Of course, a lower grade and step has a lower pensionable remuneration than a higher grade and step. So per every month that you have a certain grade and step, there's a certain pensionable remuneration scale that applies. For general service, the pensionable remuneration scale is equal to your gross pensionable salary. So to your gross salary scale. Pensionable because some allowances are considered pensionable allowances and are taken into account, such as language allowance. So for general service, your pensionable remuneration scale is equal to your gross pensionable salary. So basically, if you look at your gross on your salary slip, that is probably the basis of calculation for that month, unless you have some pensionable allowances that are part of your income. And these scales are determined by the International Civil Service Commission, not by the pension fund, and are updated from time to time. So usually in February every year, there's an adjustment to the pensionable remuneration of all of us. Not every year, but most years. So usually they are upward trending from one year to the next. And then the scale will apply for the next usually 12 months from February onwards. There's a link here if you're interested. Once you have the presentation, go to the ICSC website, the International Civil Service Commission, and you can check per grade and step of professionals what the exact pensionable remuneration is. Nothing is a secret. All of this is public. So if you're interested. So your pensionable remuneration is relevant for us to determine your monthly contributions to the fund and therefore the organizational contributions. Because you pay 1/3, your organization pays 2/3 of the total contributions payable every month per member of the fund. So the organization, based on your pensionable remuneration, will pay twice the amount that you have to pay. And that goes towards the funding of the system. Now, your pensionable remuneration is also key to calculate your future retirement benefit or to calculate any periodic benefit from the fund. A periodic benefit is a benefit payable on a monthly basis. So How does that work? We would determine something based on your pensionable remuneration over time that is called your final average remuneration. So for future retirees, when we calculate your benefit, we look at your final average remuneration. How do we determine that? We look at the last 5 years of your contributory service. So we don't look at your total career, but only at the end and the last 5 years. And then inside those 5 years, we pick out the highest 36 months of pensionable remuneration. Basically, your best 36 salary months. And we average those 36 months and obtain your final average remuneration. So in the last 5 years of your contributory service, we average the best 36 months to obtain your final average income level. And then we multiply that amount by your accumulation rate, the one that we determine based on how many years and months you contributed to the fund. And that is it. That is a base calculation of a benefit. Gets a little more complicated, but nothing that is I'm going to share here. It's about actual factors and so on. But the basis of a calculation really is that. And once we have done that, we know what someone's base entitlement is. So if someone has a normal retirement entitlement, that is pretty much the amount that they would be entitled to per year for life. And then we pay that in monthly installments of every 1/12 of that amount. If they take a lump sum, then of course we have to calculate what would taking out the lump sum mean for the lifelong portion of retirement. We'll get there later. And for someone who leaves on early retirement, we do the same calculation, FAR, final average remuneration, times rate of accumulation. And then we say, okay, so that's the base amount, but now because this person is separating earlier than their normal retirement age, it's going to cost the fund more money because this person hopefully will benefit from a benefit for a longer time in life because they leave maybe 2 years before reaching normal retirement age. Therefore, the fund has to apply a reduction factor for early retirement. So that person's benefit would then be reduced by a percentage for life to take into account the fact that they are leaving earlier, starting to receive a benefit earlier, and therefore are going to be a financial burden to the fund for a longer period in time. Of course, this is all based on life expectancy and actuarial assessments and calculations, but that's how it works. So that's the basis of calculation. It's really not that complicated. So here's just a reminder. So a basic pension calculation of a periodic benefit. So again, here we are talking about benefits payable on a monthly basis, like retirement benefits, like disability benefits, like survivors benefits, is ROA, rate of accumulation, times final average income, FAR. Another aspect that is important when we determine entitlements is your age, to see whether you have reached your normal retirement age at the time of separation, in which case you're entitled to whatever you're entitled to without any reduction factor, obviously, or if you're younger than your normal retirement age, to see if we have to then apply this reduction factor. We already talked about vesting. It's just a reminder to say, in order to be entitled to a form of lifelong benefit from the fund, a retirement benefit, you have to first vest by having contributed to the fund for at least 5 years. Once you hit the 5-year mark, you are vested. And regardless of, how old you are when you separate, you can choose a form of retirement benefit. The kind of retirement benefit will depend on your age at the time of separation. And again, disability and death coverage are not subject to vesting. You're covered from the day you join the fund if you were medically cleared. I already mentioned normal retirement age, so I'm not going to spend much time here. Just a reminder that your normal retirement age is based on the date that you joined the fund, and it will not change while you are a participant. So for as long as you're within one period of participation, even if it includes short breaks in service, special leave without pay, etc., your normal retirement age remains the same for a given period of participation based on the date that you qualify to become a member in the pension fund. And then again, based on when you joined, you have different normal retirement ages. So everyone should look at what is their situation to determine their normal retirement age. And similarly for early retirement age. I would say that the vast majority of members in the fund, participants in the fund, currently have a normal retirement age of 62 and early retirement age of 55, excuse me, and a smaller group of 65 normal retirement age and 58 early, and very few normal retirement age 60. Just to highlight once again that mandatory age of separation is not the same as normal retirement age, that mandatory age of separation is determined by your employing organization and the staff regulations, not by the pension fund, and that it could be different from your normal retirement age. It certainly is my case. I think it is the case for many. Yours too, I'm sure. Yes. Yours too. Mm-hmm. There we go. All three of us have a different normal retirement age than our mandatory age of separation. Mine is 65, mandatory age of separation, and 62, normal retirement age. And I'm certainly considering the possibility of leaving before my mandatory age of separation, hopefully not before my normal retirement age. Because I can't. All right, so if you have questions, please ask them, because there is sometimes confusion around this. I already mentioned that you can work beyond your normal retirement age. There is no problem. The fund has no say in that. We are just looking at the time of separation when we check your separation documents. What is this person's normal retirement age to determine whether you reached it or not? And if you're over, good for you. But otherwise, there's no impact. We already talked about this. Now, the different types of benefits the fund provides. This is just a first look. We're not going into the details yet. But just to say that we distinguish between settlement payments and periodic payments. Settlement payments are, for example, the withdrawal settlement. You might have heard of that. That's a one-time final cash payout to someone who elects it, or someone who is not entitled to a periodic benefit because they didn't contribute to the fund for long enough. So someone who leaves with only 4 years and 5 months of contributory service would not yet have vested their pension rights, would not yet have earned the right to elect a form of lifelong retirement benefit if they wish, so they would get a withdrawal settlement. So a settlement is a one-time final payment, and once we have paid that, there are no further liabilities that the fund has vis-a-vis that person, no survivor's benefits, nothing. Another settlement is the so-called residual settlement. That is the final last payment the fund would ever make following our participants' death, either in service or in retirement, if and once there is no more survivor entitled to regular monthly payments, and if there is still at that time a residual of the former participants' own contributions to the fund, contributions and interest, not yet paid out in the form of a benefit either to the participant or to survivors. Not very often do we pay residual settlements because most of the people exhaust their own contributions themselves in the form of a withdrawal settlement or a retirement benefit, either retirement benefit payments over life or by taking a lump sum as part of their retirement benefit. And we talk about this later, but most of the people exhaust their own contribution amount and interest amount through the benefits that the fund pays to them. Some don't, but then have survivors entitled to regular monthly payments. So then they probably exhaust those contributions. And in the few cases where there is a residual of someone's own contributions and interest to the fund, that's when the fund, as a final check, will check, and if something is payable, pay that residual settlement to the person or people that you designated on a form called A2. We will talk about the residual settlement later, but I just wanted you to know that that is, of course, part of the settlement payments. And then we have the periodic payments. Periodic payments are payments that are made by the fund on a monthly basis, periodically, and for a duration in time. Retirement payments are payable for life. They are periodic payments. Disability payments are periodic because we pay them for as long as the disability lasts, and eventually for most of the people for life. And survivors' benefits are periodic payments where we pay them to surviving spouse, children, etc., in monthly installments for as long as they are payable. So all of those are called periodic payments, and they are calculated differently from settlement payments. A settlement payment is calculated by looking at the person's own contributions and interest, and basically then seeing whether there's an increase that should be paid in addition to the own contribution and interest for the withdrawal settlement. I'll talk about that in more detail later, but that's the basis, the own contribution and interest amount. Whereas for periodic benefits, we use that formula. You've heard it now several times, the formula of rate of accumulation times final average income level. So that's the difference, periodic benefits versus settlement. And periodic benefits, of course, are adjusted for cost of living over time. So that's another plus. I don't know whether we have questions in relation to any of this. No, just standard. Yeah. In the room, do you have any questions? No? So then, what is the time? 10:32. 10:32. Okay. Yeah. I think we go through participation and then we do a very short break. And I'm not going to go into too much detail in participation. This now is mostly interesting for those of you who joined fairly recently and who might be interested in special leave without pay in the near future or future, more distant future. And for those of you who have breaks in service, periods of break in service. So this is about participation, about your being a member in the fund, paying contributions to the fund, or at least being a participant in the fund. So I will first of all talk about what qualifies someone into the fund. Not everyone who's a staff is immediately a member of the pension fund. You have to qualify by having a contract as a staff member. If you're not a staff, you're a consultant, you can never be a member in the UN pension fund. Or a UN volunteer, unfortunately, cannot be a member in the pension fund. So you have to be a staff member, and then the duration of your contract is another qualifier. The contract must be of 6 months or longer, in which case the staff immediately becomes a member of the fund. So if you started your career on a 6 months or longer contract as a staff, you were in the fund immediately from day one of that contract. But that is not the case for everyone. A lot of people actually started or start on contracts that are shorter than 6 months. So then what? Then the person must fulfill the 6 months contract requirement. So in that case, if someone has a shorter than 6 months contract at the beginning, but is a staff, that's important, then once they have completed 6 months of service on a series of contract that cannot be interrupted by more than 30 days at a time. Once the person has completed 6 months on that series of contract, once they get an extension beyond 6 months, they are in the fund. So I'll give an example. If someone has a 2 months contract, then has a break of 10 days, and then has another contract of 2 months, has another break of 10 days, and then gets a 6 months contract, that person would be in the fund from the first day of the 6 months contract because, boom, the 6 months requirement is fulfilled. Let's backtrack. What if the person had a 2 months contract, a little break of 10 days, another 2 months contract, another break of 10 days, another 2 months contract? not yet in the fund, but completed 6 months on consecutive contracts without interruption of more than 30 days. They get now a 1 month contract extension. They are in the fund from the first day of the 1 month contract extension because they completed 6 months on the shorter term contracts, consecutive contracts with breaks in service of not more than 30 days between contracts. You don't really have to worry about this because that assessment is done by your employing organization and they report the staff to the fund as a new member once the 6 months requirement is fulfilled. But many of our members come to us and say, I see in my pension statement that I started contributing to the fund only as of 1st of June 2010. However, I actually started work on the 1st of March. So why? I should have been in the fund from the 1st of March. The answer then is no, unfortunately, because you had short-term contracts less than 6 months, you were actually not yet qualified to be in the fund. Now, once the person then qualifies, the one that had shorter term contracts, and then eventually qualifies for pension participation, that person has the possibility to validate those, let's say, 6 months of non-contributory service in the fund and make it contributory and make it part of their participation by opting to pay contributions, their own share, to the fund. That is called validation, and someone would have to apply within 12 months from qualifying for pension fund participation to validate a period of prior non-contributory service. I mentioned that in a moment again, but I just wanted you to understand that if there are colleagues here today that have this discrepancy between when they started working for a pension fund member organization as a staff, but started in the fund only a bit later, that is probably why. Probably you had a short-term contract. All right. So, and then once you qualify for pension fund participation, you are a participant in the fund. You start your participation based on the date that you qualified. We determine your normal and early retirement ages, and you are now paying contributions. And that's when we then look at your grade and step month after month to determine what is the amount of contributions you have to pay based on your pensionable remuneration rate. And this is where you pay 1/3 and your organization pays 2/3. Very nice, lucky us. Many pension plans in the world have a very different distribution of contributions. It's inverse oftentimes, or it's even employers pay nothing towards the pension. So I consider myself lucky to be part of a fund where we are actually only paying 1/3 and our organization funds us for 2/3 for our future entitlements. Yes, of course. No, that is not correct. That should not have been the case. And if that is something, you should maybe contact the fund so we can clarify. Because when you validate, so this is about validating a period of non-contributory service, you should only pay your own contribution share and the organization pays the other 2/3 share that you are allowed to validate. So for the period that you're allowed to validate. Yeah, so maybe we can look at your case. If you give us your number, we can have a look at that. All right, so thank you for the question. And in case you have more questions about participation in the fund, there's a link to the page on our website that goes into much more detail. If you brought your salary slips with you or you have them at hand, you would see in the top left corner of your salary slip something, this is the UN slip, UNICEF, UNDP, you all have different slips. But on your slip somewhere, you should see something called pensionable remuneration, which is what I've been talking about. It's based on your grade and step to determine your contributions to the fund. So when you see that amount, the amount you see is the annual value of that rate based on your grade and step at the time that we're looking at it. So here, this is my payslip in 2020 November. Doesn't matter that it's outdated. So at that time I was a P56, and during the month of November, when I was the P56, the according pensionable remuneration rate for a P56 in the UN system was $218,528. That's the annual value. So to determine what I have to pay for my monthly contribution, we divide that 218,000 by 12 and then apply 7.9%, which is the rate that we pay as participants. 7.9% of our pensionable remuneration is payable from our salary, just a 12th from that amount that we see on the top of the corner. So if you're interested to understand what this amount means on your salary slip, that's the pensionable remuneration. And then you can see on the slip somewhere that your own staff contributions are a certain amount. And then there's also usually the organizational share, which should be twice the amount of your own contributions. So that's what you can check on your salary slip. Mind you, the pensionable remuneration, some people think the amount they see there is what they will get in the future as their retirement income. I would congratulate all of us if that were the case. It would be amazing. It's not the case, okay? So this is the basis of calculation, both for your contributions and in the future to calculate your final average income level. But this is not the amount you will get, not as a retirement benefit, not as a withdrawal settlement, not as nothing. Okay, so a few terms that might be useful to understand before we move on. We already talked about participation. It's mandatory. You can't opt out. Your contributions are deducted by your employing organization and reported by the organization to the fund. They do that month after month and report at year end. We cannot accept voluntary contributions in the fund, so you can't offer us to pay an amount of money to increase your future entitlements. We do get these requests. It is not possible. And vesting, we already covered. You are vested for lifelong retirement entitlement once you have at least 5 years of contributory service. Again, the kind of retirement benefit you would be entitled to would depend on your age at the time of separation. Number 5 is very important in my view. It's about interest. You earn interest, compound interest on your own contributions. The higher your own contributions, the higher your interest. And if you look at your pension statement, you will see that you probably earned a substantial amount of interest if you have a certain period of contributory service already. So it's compounded interest, meaning it exponentially increases over time. And that interest is part of any payout as a withdrawal settlement or lump sum. We cannot, and I'm now going to point 6, we cannot extend personal loans. It's not possible. We are not UNFCU. We are not a bank. We cannot take out money because it would mess with the actual projections for the longevity and the solidity of the fund. And we also cannot make payments to a third party. So this is just a practical reminder that the fund makes payments only to our former participant or the beneficiary into an account in your name. If you have a joint account, no problem. But your name must be part of that account. So we cannot pay directly to a bank to reimburse a loan. We cannot pay directly to another person because you don't have an account. It must be an account in your name. And then finally, another practical point. Yes, please go ahead. That's a very good question. So the question was, can payment be made? Oh, okay.
Yes, I will repeat the question. Can it be paid, the pension can be paid in an account in the US, for example, in UNFCU, or it should be paid just in the country where I was retired? Thank you.
Thank you for the question. You can be paid into any bank that is a commercial bank worldwide. So if you reside in Panama, but you want to be paid into a US dollar account in the US, no problem. If you reside in the US, but you want to be paid into a US dollar account in Switzerland, no problem. So you are in charge of deciding in which country and account you want to be paid and in which currency. The fund will execute your instructions. That it depends. And it depends on the kind of payment, whether it's a payroll, currency, and so on. I don't want to go into the payment questions right now because we are far from benefits, but if you are here this afternoon, we can talk about all of that. All right, so final point here was that the fund cannot release confidential information to a third party. We protect your data very seriously. So if you have a colleague, a family member, a friend calling us on your behalf saying, hey, I'm Christine, I'm calling on behalf of Mercedes. She is not well right now, so I just need to know how much is she entitled to and so on. The fund will say, sorry, Christine, you are not Mercedes and we do not have an authorization from her on file to allow us to let you know this information. So in other words, if you want even a family member to be able to access information about your file in the record of the fund now or in the future as a retiree, you have to submit a written statement dated and hand-signed, naming the third party, whether it is a lawyer or it is a friend or it is a family member, and saying specifically, I allow this third party to receive information on behalf of my account in the fund. And then we will honor that. But you have to put that on file. You can upload that kind of statement by uploading it in member self-service. We'll look at it in a little bit, but just so you know, otherwise the fund will not release information on your behalf to a third party. While you are a participant, of course, we do release information to your employing organization because basically all the information we have on file comes from your employing organization. But once you're separated, even your employing organization is a third party for us. So unless there is a very good reason or it's not something highly confidential, even your former employing organization, we would not release information to them. Okay, so once you're then a participant in the fund, and we already talked about this, so I'm going to skip these slides very quickly. You are covered for the risk again of disability and death, right? We covered that. If you're interested in more detailed information about disability, there's a link here directly to the webpage that contains a lot of information about it. And death in service, same. If you have any need any information about survivors benefits, then there's a link here directly to the relevant webpage on our website. We are going to talk about survivors benefits later, but just to say, once you're a participant, again, you're immediately covered for the risk of disability and death. Now, again, and we already talked about this, once you're a participant, it is important to remember that the length of your contributory service will determine your future entitlements. So the longer it is, the better. And if you have options to increase your contributory service, you may want to consider these. These options only exist for certain people in certain situations, and they are subject to very strict deadlines and timelines. Once that kind of time or deadline is passed, the person is time barred. I will talk about them. Validation is part of these options that I'm talking about. So what are these ways to increase your contributory service? There are not many. And again, they are subject to a person being in a specific situation. We already discussed the first situation, which is validation. This option of making a contributory service period during which, making a period. I'm going to start again. Making a period when you were already a staff member, but not yet entitled to be in the fund, contributory service. That is possible by applying within 12 months from actually qualifying for pension fund participation to the fund and asking to validate that prior non-contributory service. When you were a staff, but because your contract wasn't long enough, you were not yet allowed to be in the fund, and you did that. So validation then means that you pay your own share of contributions, and your organization pays the organizational share. You have to first go through an eligibility check in the fund. We check if you're actually eligible. If you are, we tell you how much money you will have to pay. And if you then confirm, yes, I'm going to do that, you pay your amount, your organization should pay their share. And by doing so, you are now making that period contributory service, so that when we calculate your entitlement in the future, we take your total contributory service, including the validated period, to calculate your rate of accumulation. Your date of entry, however, is always the one when you actually qualified to become a member in the fund. So you would not change that by validating. It would not become an earlier date through validation. What you're doing through validation is bringing your beginning date of contributory service a little bit into the past because you validated that period. That's option number one. Option number two is called restoration. Option number three is called transfer of pension rights between an outside pension scheme of an organization, international organization that is not a member of the pension fund, like the World Bank, like the IMF, like the European communities, like some Inter-American Development Bank, etc. So someone who comes from an outside international organization to the UN pension fund and the UN system can opt to bring in their acquired pension rights from that outside organization to the UN pension fund. I will explain a bit more in a moment. You can also opt to take your acquired pension rights from the pension fund if you are leaving your organization and moving to such outside international organization and transfer your acquired pension rights out to that organization. There needs to be a transfer agreement in place between the UN pension fund and that outside pension plan. We have 25 such agreements, and they are all posted on our website. So if someone moves from outside to the pension fund or from the pension fund to the outside, I would strongly suggest contact the pension fund to make sure that we give you information as needed, and you could check whether you are interested in possibly availing of such transfer. And the last part where you could make a period of non-active staff service, contributory service in the fund, is during leave without pay, where you have the option to pay contributions to the fund during such period if you wish. You're not obliged, but if you have a leave without pay period that you want to make contributory service, you can do that. I will explain to you how. Just remember, you will have to pay your own and the organizational share. So for leave without pay, if you do want to pay contributions, then that's on you to pay your own and the organizational share. It is expensive, and I would say definitely maybe consult the fund to see whether it is worth it in terms of what that would yield as an increase in your entitlements in the future, to see whether it's actually worth the investment. So quickly, we already talked about validation, restoration. Restoration is this option for someone who was a member in the pension fund and who then separated and then returned to the pension fund to make that, to reimburse a withdrawal settlement that they had received from the pension fund. So someone was a member in the fund, separated and sorry, we had a microphone change because we ran out of battery. Okay, so once again, restoration is that option for someone who had received a withdrawal settlement when they separated from the fund to reimburse that withdrawal settlement to the fund if and when they return to work again for a UN pension fund member organization and would like to return the withdrawal settlement amount to reactivate the contributory service period for which they had received it. That's called restoration. So if I had worked and then separated after 4 years of working and contributing to the fund. Let's say I received $50,000 payout from the fund as a withdrawal settlement, and 10 years later, I come back and I again work for UNICEF. At that point, I again join the fund. I now have the option to reimburse those $50,000 that I had received to the fund, plus compound interest, and by doing so, reactivating my 4 years of contributory service that I had before separating. So by doing so, I would reactivate the contributory service of the past and make it part of my new contributory service that I'm starting. When I again separate, my entitlement would be based on the total contributory service, including the restored period. So there's a 1-year deadline from the date of rejoining the UN Pension Fund to apply for restoration. There's a new provision that recently became effective on the 1st of January this year that also allows to restore a deferred retirement benefit if someone had become entitled or earned an entitlement and elected or was deemed to have elected a deferred retirement benefit. I'm not going into too much detail here because there are very few people in that category, but if anyone who is currently in this session has an entitlement to a deferred retirement benefit and that is not yet in payment, then you may be eligible to restore that deferred retirement benefit. What that means is that the fund would calculate would make an actuarial calculation, and that has to be cost neutral to the fund. That's as per the new provision, to see how much a restoration of your deferred retirement benefit would yield in terms of contributory service. And then you would decide whether that is in your interest or you rather keep your deferred retirement benefit as is and start a new period of participation and earn a new benefit separately. So for those that might be in this situation, if you have already an acquired right to a deferred retirement benefit, please contact the fund so we can explain to you this new option that is available to those who fulfill the conditions. It's a very complicated provision. It's often not beneficial for those who are actually in this situation, but at least it would be good if you are in the situation to get an estimate to see whether you are interested or not in restoration. For those with a withdrawal settlement, it usually is very interesting to do that. So keep that in mind. And then finally, transfer agreements. This is what I mentioned earlier. For those of you who who used to work for an international organization that is not a member of the pension fund and then separate and come to the UN system and become a member of the UN pension fund, you could consider whether you wanted to transfer over your acquired pension rights from that outside pension plan. Why is that of interest? Because it would allow for portability of pension rights and you can consolidate in one pension plan all your pension rights. And usually there are requirements of a minimum of a certain number of years to be entitled to future retirement benefits. And if you have a few years here in this pension plan and a few years there, you may not ever get to the point of earning actual vested pension rights anywhere. So by taking your pension rights from one international pension plan to the other, you may be able to have one acquired pension rights in one pension scheme. Again, this only works if there's a transfer agreement in place between the outside pension plan and the UN pension plan. We have actually 25 now, so this number is outdated. So if you are in the situation of leaving to another outside international organization, not member of the pension fund, contact us so we can explain this more to you. And vice versa, if you're coming recently from an outside international organization, please contact us so we can tell you whether you're possibly eligible to transfer in your pension rights. Again, if you do that, then the amount of money you transfer into the UN pension fund would buy you a certain period of contributory service that we would then add to your actual contributory service and base your future entitlements on the transferred period and the actual period that you contribute to the fund. Just so you know, not every transfer yields a one-to-one. You would not necessarily buy the exact same period of contributory service in the UN pension fund that you had in your outside pension scheme, and vice versa for the transfer out. I stop here. There are links to the relevant web pages for each of these provisions: validation, restoration, and transfer. Anyone interested, I would strongly encourage you to first read the web page. And then, of course, if you have questions, please contact the pension fund. Last point, special leave without pay. So anyone, of course, if your organization permits, can go on leave without pay. And we see in the fund that many, many people do. When you go on leave without pay, you remain a participant in the fund. You're not stopping participation because you're inactive as a staff. Now, you have the option to pay contributions while on leave without pay. You don't have to, but you could. If you do want to make contributions, while on leave without pay, you have to pay out of your own pocket your own and the organizational share. If you say, I don't know how much that would be, go to your most recent salary slip, add up your own contributions and the organizational contributions, and you will know how much you would have to pay months after months. Also, you would have to make the arrangement to make payments for leave without pay with your payroll office, not with the pension fund. So it's your payroll office and your organization that would be your point of contact for this arrangement. And finally, you would have to start making these payments as of the start of your leave without pay, and then concurrently with your leave without pay. You cannot make retroactive payments for a period of leave without pay that you had in the past, where you say now, oh, maybe I do actually want to make it contributory service. That's too late. So if you are considering leave without pay and you're considering making payments for pension, keep in mind you have to set up everything ahead of starting leave without pay so that the fund receives your contributions concurrently with your leave without pay. In that case, in our books, you are a normal participant, active participant who earns contributory service and who increases their rate of accumulation, etc., per that contributory service. Mercedes has a little point.
Sobre el leave without pay, lo que es importante es no contactar directamente con la caja de pensiones. Es mejor contactar con payroll, porque es a ellos a quien pagarán y ellos nos enviarán las contribuciones.
Muy importante.
Muy importante.
Muy importante. And we say this because we have numerous cases where people contact us and say, if I had known, so I want to now make these arrangements. And we say, no, sorry, too late. So don't wait for the pension fund. Inform your payroll as soon as possible. And of course, if you have any questions or you want to get an estimate of how much would I get if I do make contributions, then please contact the fund so we can give you that estimate so you can make the assessment of whether it's worth it. You can always stop making contributions. So if you start, but then decide this is actually too expensive for me and I don't think I want to continue, then you can stop making contributions for leave without pay. But you cannot start contributions after you already started leave without pay. Of course, most people actually don't make contributions. So most people who go on leave without pay will not pay contributions to the fund during that period because it is so expensive. Now, in that case, that's fine. You remain a participant. Simply, you are not earning contributory service. So it would show as an interruption of your contributory service. The maximum leave without pay without contributions that anyone can have is 36 months total while a participant in the fund. And this is from the fund perspective, not from the organizational perspective, meaning the fund doesn't allow a participant in the fund to have more than 36 months of leave without pay without contributions to the fund. If you exceed 36 months, we separate you from the fund. And then only once you come back to active staff status would you re-enter the fund. Now, your organization may allow you more than 36 months of leave without pay. And it doesn't matter for the fund whether your leave without pay is interrupted or one consecutive period. We have a total of 36 months that we allow interrupted or consecutive leave without pay. So keep that in mind. If you know you had a period of leave without pay a few years back and now you do want to do another 2 years, keep in mind that when you, in our records, hit 36 months, we will consider that you were separated. Now, the problem is that we don't get reporting on your leave without pay in real time. So it could happen that the fund realizes only later when we do a reconciliation of your records at the time of separation, final separation, that you had more than 36 months of leave without pay somewhere in your participation. So then we will have to at that point say, well, that person should have been separated. This should be a period of break in service, and then they rejoined and continued. So this is not very often, but it does happen sometimes. Could keep in mind, no contributions during leave without pay means you cannot exceed 36 months or the fund will separate you. But you can, of course, vis-a-vis your organization, have arrangements to be on leave without pay beyond 36 months. That's none of the fund's business. I'm talking about how we are going to reconcile your records later. So a whole page on leave without pay on our website explaining all of this in detail. Definitely, if you consider leave without pay at any point, please make sure you read that. And if you have questions, you reach out to us. And as Mercedes said, if you do go ahead and you want to pay contributions, contact your payroll office before starting leave without pay to set up that payment arrangement while you are on leave without pay. Final point, part-time. This is not about earning contributory service. This is about what happens if you work part-time. If you work at least 50% part-time, then you remain a participant in the fund. You will continue paying contributions, but it will be prorated to your part-time status. So if you have part-time periods of less than 50%, so if your part-time is less than 50%, then you are not qualified to be a member in the fund and you would not pay contributions and you would not earn contributory service. It would be considered a break in service. All right. So again, if you are at least 50% part-time or more, you continue being a member, you continue participation, you continue earning contributory service, and you will increase your rate of accumulation, but your rate of accumulation will be increased prorated to your actual part-time situation. For vesting, for earning the right to a form of retirement benefit, where again, remember, you have to have at least 5 years of contributory service, for as long as you have at least 50% part-time, you still are considered earning towards your contributory service. So in other words, if you have 2 years full-time and 3 years part-time, 50% or more, at the end of 5 years, even though 3 were part-time, you are vested. So we consider it differently for vesting purposes than for calculation purposes. And finally, breaks in service. There. I know this is a very dense little paragraph here, the BIS, break in service. I'm not going to break it all down into nitty-gritty detail right now. I just want you to know that you can have periods of break in service inside your participation and not have been separated and ended participation. If you have breaks in service that are less than 30 or not more than 30 days, and if you then, after, let's say, 29 days of break in service, you get a contract again for 2 months or 3 months or 10 months or 2 years, doesn't matter, you're immediately back in the fund and continue contributing and continue your participation from the first day of your next contract as a staff. So if your break in service is not more than 30 days, it doesn't matter how long your next contract is, you immediately continue pension fund participation for as long as you have a staff contract when you continue. However, if the break is more than 30 days, you first have to requalify for pension fund participation by having a 6 months or longer staff contract or reaching 6 months before you continue participation. And if your break-in service is more than 36 months and you didn't receive a payment, you end your participation. In other words, we don't accept a break-in service of more than 36 months. Or rather, let me rephrase that. If your break-in service is more than 36 months, you will have ended one participation. And if you come back and again qualify for participation in the fund, you start a new separate period of participation with a new date of entry and a new possibly normal and early retirement age, etc. So 36 months break-in service is the maximum we allow. If you return within 36 months of break-in service and you didn't receive a benefit or you didn't make a benefit election within 36 months, then you just simply continue your existing participation. And as soon as you're again active in the fund and paying contributions, we continue counting contributory service, adding it on to your already acquired contributory service in that same participation. I know it's a lot of information, and just so you know, there's a web page on break-in service. All of this is managed by your HR and the fund, not you, but it's good to know. There's a question from the floor, so I don't know whether you have a mic.
Thank you. In terms of communication when a break-in service occurs, for example, is the pensionist or the staff who has to communicate the pension fund, or is through the payroll? Because I tried to contact both and I couldn't have any answer.
Okay, yeah. No answer is not good.
But, yeah, no, but
no.
Yeah.
So in terms of communication, if you have a break-in service, there is no normally there is no communication. It's just that the systems communicate. So your break-in service means you have a separation document issued for your ending one contract, and then you have the break. And then when you rejoin, you have the next PA issued personal action form, which will then trigger that data being transmitted to the fund. So normally this should all be interfaced and happen in the systems, but communication wise, unfortunately, it's true, there is kind of like a black hole. Unless you ask, you would not proactively be contacted about this. Not, I think, by your organization and not by us, the pension fund. But if you wrote to the fund, normally you should get an answer, obviously, so that's concerning. But if you didn't get an answer, please let us know so we can check your case. We might not be able to give you an answer if we don't have the personal action on file or the information on file yet. Then we would ask for it. But definitely we can look into this to get a better idea of what is going on. Okay. All right. So that's for break-in service. And final point, if you have any questions or interest in participation and anything that we covered so far, there is an e-learning module on our website that everyone who is a member in the fund can access and take. It's a, interactive learning module where we break all this information down step by step, including information beyond what we discussed. That e-learning includes information about benefits, future entitlements, and so on. So if you haven't yet and you're interested enough, I would encourage you to take that module. It takes an hour and 20 minutes, roughly, maybe an hour and a half. But it's definitely something that would leave you with a very solid understanding of all of this, if you're interested. We have also e-learning modules on separation and retirement, on in retirement, so once someone is actually in receipt of a benefit, and one on the so-called two-track. So that's just a reminder, and there's a link here, and of course a link also to our different various tabs on the website. Now, if you want a little break, I would say we do a 5-minute break till 20 past. I know we're getting close to the end of the first session. So I will start talking about benefits before we break for lunch, and then we will talk about benefits at the beginning and continue talking about benefits at the beginning of the next session. So it will reach into the next session. Okay, So what do you think? 5 minutes or 10 minutes? Minutes. 5. Oh. You want 10?
No, it's all right.
10? 10 minutes.
Yeah.
All right. A 10-minute break. Yes. 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 We are all very cold here in this room, so we'll go and step into the sun. So 10-minute break. It is now 1:15. Please rejoin at 25 past. Thank you so much. And thank you to everyone online, of course.
What are your benefit options when separating from service or retiring? Your options depend on how old you are and how long you have worked for a UNJ SPF member organization while contributing to the fund. To help you decide on an option, register in the fund's member self-service portal and run estimates with the simulation tool available there. First, let's take a look at the benefit options. Option 1. Withdrawal settlement. If you have less than 5 years of contributory service, you can only take a withdrawal settlement. This means you will receive your own contributions to the fund plus interest. If you have 5 or more years of contributory service and you have not reached your normal retirement age, you can also take a withdrawal settlement. You will not only get your own contributions plus interest, but also an additional 10% of your own contributions plus interest for every year of contributory service, in addition to your first 5 years. The 10% increment per year continues for 10 years and is capped at 100% of your own contributions plus interest. Before presenting the next benefit options, let's first talk about some important ages. If you entered the fund before 1 January 2014, your early retirement age is 55. If you entered the fund after that date, then your early retirement age is 58. If you entered the fund before 1 January 1990, your normal retirement age is 60. If you entered the fund between 1 January 1990 and 1 January 2014, your normal retirement age is 62. After 1 January 2014, your normal retirement age is 65. Option 2. Deferred periodic retirement benefit. If you have 5 or more years of contributory service and you separate from service prior to reaching your normal or early retirement age, you are eligible to elect a deferred retirement benefit. This means that your benefit will become payable, usually on a monthly basis, at your normal retirement age, or at your request, any time between your early retirement age and your normal retirement age. Should you elect to commence payment of your deferred retirement benefit before your normal retirement age, a corresponding reduction factor will be applied for life to your entitlement. Keep in mind that, with this option, your contributions will not earn further interest while waiting for your deferred retirement benefit to come into payment. Also, with a deferred retirement benefit, no child's benefit is ever payable. Option 3. Early retirement benefit. If you have 5 or more years of contributory service and you have reached your early retirement age at the date of your separation, but not your normal retirement age, you can elect an early retirement benefit, which will be paid monthly from then on. However, your benefit would be less than if you had waited to receive the benefit at your normal retirement age, as reduction factors will be applied, which get less the closer you get to your normal retirement age. You can choose to take a lump sum up to 33% of your entitlement, but that would mean that your monthly benefit would also be reduced. Keep in mind that your children under the age of 21 will only qualify for a child benefit when you reach your normal retirement age, and only if they are still under 21 at that time. However, the child benefit would be payable immediately if your child is found by the fund to be disabled. Option 4. Full retirement benefit. If you have 5 or more years of contributory service and you separate at the normal retirement age, you will be entitled to a full, unreduced retirement benefit. which will be paid monthly from then on. With a full retirement benefit, you can choose to take a lump sum of up to 33% of your entitlement immediately, but then receive less in your monthly pension payments. Option 5. Delaying election of benefit. This is not a benefit, but it's an option you have as long as you have not reached your normal mandatory age of separation from service, applicable in your employing organization. In the UN, the mandatory age of separation is 65. So if you haven't reached this mandatory age of separation, you can delay your choice of benefit for a period of up to 36 months while you look for a new job at the same or another UNJ SPF member organization. Should you rejoin the fund within the 36-month deferment period from your date of separation from service, your participation will be considered to have been continuous. The following examples illustrate different scenarios that might apply in your case. Meet Khalid. Khalid has worked for a UNJ SPF member organization for less than 5 years. Because he has participated in the fund for less than 5 years, Khalid can only take a withdrawal settlement. He also has the option to defer his decision, meaning he could delay his decision for up to 3 years while he looks for a new job at a UNJ SPF member organization. Meet Priya. She worked for a UNJ SPF member organization for more than 5 years and is leaving her job, so no longer contributing to the fund. She is 45 years old, so is younger than the age for early or normal retirement. Priya has 3 options. She can take a withdrawal settlement immediately. Priya's second option is to delay her decision for up to 3 years while she looks for a new job at a UNJ SPF member organization. Her final option is to choose a deferred retirement benefit. Meet Louise. She has worked for a UNJ SPF member organization for more than 5 years and has now reached her early retirement age of 55. She is no longer working for a UNJ SPF member organization. She has 4 choices. First, she can take a withdrawal settlement immediately. Second, she can choose to delay her decision for up to 3 years. Third, she can choose a deferred retirement benefit and wait until she reaches normal retirement age to begin receiving monthly benefits. Finally, Louise has the option to take an early retirement benefit. Meet Carlos. He has worked for a UNJ SPF member organization for more than 5 years and is 62 years old. He has reached his normal retirement age. Carlos has 2 options. First, he can delay his choice of benefit for up to 3 years while he looks for a new job, but he must be careful not to take a new job that has a lower pensionable remuneration rate, because that would reduce the amount of his pension benefit from the fund. Second, he can choose a full retirement benefit that the fund refers to as an unreduced benefit. This is a simplified overview to give you an idea of your benefit options. For more detailed information, please visit unjspf.org.
All right. Okay, I hope the audio is okay. We saw one message that someone didn't have audio, but otherwise none. So I'm hoping that you were able to hear the content of the video. I know there are subtitles, but it is nicer to hear it than just see it. So I'm now going back to sharing my presentation. Thank you for being back and for having listened to this video. Sorry, I have to put it in full mode. Oh, I didn't share. Sorry, I thought I'm sharing. Oh yeah, okay, I get it. Sorry. I'm sharing the wrong screen. I'll share again. Thank you. That's right. Yeah. All right. So we're no longer in break. All right. And make it big. There we go. All right. So you got an overview of your different benefit options depending on the various factors that determine what your options may be. We will, of course, go into the different benefit options in more detail because it was a lot of information in a few minutes. But I hope it gave you a general idea of, how we determine who is entitled to what kind of benefit, and then also what the high-level attached provisions are for each of the benefits. So before I go into the details, a reminder once again, there is a whole e-learning module, again, roughly takes an hour and a half, on benefits and separation essentials that you can join via the website link that is provided here. Or if you go directly to our website under resources, you have the e-learning modules. And then on that page, it takes you to the page where you can register or enroll for the e-learning and take it. It's obviously free, but also it's hosted on the UNSSC Blue Line platform. Anyone should be able to join that, and it might be a good idea for those who are separating to take that module just to solidify all of this information. So we already talked about the different benefits and the different kinds of benefits we provide. So a quick reminder, difference between the settlement payments and the periodic benefits is that the settlement payments are calculated based on your own contribution and interest amount versus the periodic benefits, which are calculated taking into account the length of your contributory service and your final average remuneration. So I'll skip because we talked about this already. Now, your benefit options are determined on your separation date. What does that mean? It's based on your separation date that we determine the length of your contributory service from the start of your contributory service till the end. And if there are breaks in service in between and leave without pay, without contributions and so on, that obviously would not be part of contributory service. And then once we have determined your contributory service period, calculate that rate of accumulation, that percentage rate, that then translates or is a multiplier for your final average remuneration. And then the other factor that's very important is your age. I'm sure you have understood by now that your age determines for us what kind of benefit you are entitled to. And then for those who are getting an early retirement benefit or a deferred retirement benefit that starts into payment before you reach your normal retirement age, we then also calculate your reduction factor, taking into account the length of your contributory service and taking into account how many years and months you're younger than your normal retirement age at the time of separation. But that is only for those where a reduction factor applies because of early retirement or deferred retirement starting into payment before you reach your normal retirement age. So I talked earlier about the pension statement, and this is a moment to just have a look at the pension statement with you all. And I think this is probably going to be maybe the last thing we do before we break. But if you have your pension statement, pull it out now so that we can go over it together. If you don't have it, don't worry. It's not rocket science, but it's just easier to follow if you have one. If you don't have it, again, reminder, you can access this in your member self-service for the pension fund under the Documents tab. There should be the pension statement for 2022 and prior years. So, reminder, this statement is a summary view of your participation in the fund since you joined the fund. So it goes until the year end of the most recent prior year end. This statement here, the example I'm giving you, is an outdated statement. It's for 2018. Nowadays, you would see your 2022 statement, but that doesn't matter because the concept of the statement hasn't changed. And what I'm going to go over, you can follow looking at your 2022 statement, even though I'm looking at a different year. So on the first line, you have your personal data. Check that your name is correctly spelled. Check that your date of birth is correct. Those two items are very important. We use your name as reported to us by your employing organization to verify that you are indeed the person who should get a benefit. If we get a ID document with a completely different name for you when you submit your documents, we will get back to you and your organization to clarify what is going on. So if your name is not correct here, especially if your family name is erroneously spelled, but even if you want to correct your first name, please make sure you do that. And of course, your name should also match your name in your bank account, because we are going to push your money to the person and the name that we have on file for you in our records. So if you are, like I take my own example, in the records of the fund for the longest time, I was Christine Höfer, which is my maiden name. And in the meantime, I got married and my bank account is Christine Kartner. If I submit payment instructions that say Christine Höfer, the money being pushed to my bank in the name of Christine Kartner should not get to my account. Maybe the bank is inattentive and lets it go through, but really it shouldn't go through, right? So make sure that your name is correct here and in your records in your organization. And if you have an issue and you say, oh, there's a problem with my name or there's a problem with my date of birth, don't come to the pension fund. Go to your HR in your organization to address that with them. Why? Because all the data that the fund receives on behalf of every individual member has to be reported to us by the employing organization. The owner of that data is actually your organization until you are a retiree. So go to your organization, say there's an issue with my date of birth or there's an issue with my name or with your family status. If you're not single, but it says single in the statement, you may want to go and check with your organization that they have your real marital status and then report it via a PA to the fund or via interface. So then the organization would come to the fund and inform us of the change that needs to be made. Normally, there's no problem except for dates of birth. If a date of birth is changed more than 2 years after you joined your organization, normally the fund cannot accept that. You have a duty as per the staff regulations and rules and policies to make changes to your personal data within 2 years from joining if it is about date of birth. Of course, if you have children or your marital status changes, that is not subject to the 2-year rule. So if there is a problem and the months and the day and the months are inversed, which sometimes happens, right? So some countries' offices use the format of the like US format of months followed by date, day followed by year, and others use the format day, month, year. So that happens sometimes, and if that is the reason for the error, I think there will be no issue in correcting. But if you come forward and say, I'm actually 7 years older than what was reported, I don't think that's going to fly with a pension fund. And you can guess why, because the dates of birth that we receive determine your future entitlements. And if you are actually 7 years older and entitled to a normal retirement benefit without reduction factor, but that is only reported to us several years after you joined, we probably won't change the date of birth. This also is because our presumptions, actuarial projections are all based on data on file, including the age of our membership. So if we now change the age of 100 people and they're actually 7 years older, the whole projection is off. So anyway, if you have something to fix, start with your organization and then they should report it to us and then we fix it. And if there's a major issue, there will be probably some time going by before this is going to be fully addressed. You see that in the most right corner of the first line A, you have your NRA, that stands for normal retirement age. It should be the correct one based on your date of entry into the fund. If you have an issue, then contact the fund. If there's anything wrong with, or you don't think it's correct, relating to your NRA or to the boxes B, C, D, and E. If you have any issue and see something that seems not correct, contact the fund. Your organization would not necessarily be able to assist. That's where the fund would look into the details and, if needed, coordinate with the organization. Box B is your contributory service. You have number 1, beginning date of contributory service, and number 2, date of entry into participation. This is back to what I explained earlier. Your date of entry into participation is the date when you qualified for pension fund participation and you started your participation, the date that determines your NRA and your early retirement age. However, colleagues who validated, restored, transferred pension rights might have an earlier beginning date of contributory service than their date of entry into participation, because they validated a period prior to actually qualifying for pension participation. So they would have an earlier date as the beginning date of contributory service under number 1 than their date of entry into participation. That's totally normal for those cases, and just reflects the difference between starting contributory service versus starting participation. At the end of this box, last line, total at 31 December, you have the total number of years, months, and days that you contributed to the fund. That is a period that translates into your rate of accumulation. And then you have a column on the right, leave without pay, LWOP, / break in participation or break in service. Those are periods when you were a participant but didn't contribute. So this person here had 1 month and 23 days of break in contributory service. Maybe it was a leave without pay period, maybe it was a break in service, maybe it was several breaks in service, but the total period of breaks is 1 month and 23 days of non-contributory service inside their period of participation. So if you find there is a period that doesn't make sense to you, and you say, I never had a break in service, I never had a leave without pay, or I didn't have 7 years, well, contact the fund. And then box C, contributions. This is your own contributions, not the organizational share included. So this is just what you contributed from your salary to the pension fund and the interest you earned. So here this person at end 2018, but you will see here the year end 2022, total contributions you made since you joined the fund and the interest you earned. This person paid over $76,000 to the fund for the 15 years and 4 months that they contributed and earned interest of over $17,000. So here you see that the compounding of interest in the fund is very beneficial and yields significant interest. And one more time, that is the amount, the own contribution plus interest, that would be the basis of calculation for a withdrawal settlement. And if you were to be entitled to a normal or early retirement benefit, that is the amount that you would be entitled to as the maximum to take out as your own, as the lump sum. The maximum lump sum you can take out under normal or early retirement is the equivalent of your own contributions and interest. It would be a little bit more because you also have the contributions and interest of 2023. But this gives you a good idea of what amount you would be allowed to take out. And later, when we talk about the residual settlement, that is the basis for calculating whether we paid the equivalent of your own contributions and interest or not by the time that you have died and any potential survivor has passed away, to see whether we paid this amount or less. And if we paid less, that would be the residual to be paid out as a final residual payment if there is a residual payment. Okay? Thank you so much. And then under E, you have your pensionable remuneration. Here we go back to this concept of your pensionable remuneration that we looked at on your salary slip earlier, which again is not what you will get from the fund when you separate, but is the basis to calculate based on your grade and step over time what you contribute to the fund and also will be the basis to calculate your final average remuneration, your final average income level, where again, we're going to look at the last 5 years of your contributory service and your pensionable remuneration month after month, and then take the highest pensionable remunerations for the best 36 months in the last 5 years or 60 months of your contributory service. We then average those best 36 months to obtain your final average remuneration. And when we calculate your retirement benefit, you can now tell me, what do? We take your final average remuneration times your rate of accumulation based on your years of contributory service. So here you see I highlighted in box E at the bottom right corner, line 20. That is the most recent pensionable remuneration for this case. So this person from the 1st of January 2000, in this case 2015, for 48, I think, consecutive months, had a pensionable remuneration of 78,400 something. So you see here that pensionable remuneration doesn't necessarily change from one month to the next. Oh, you can't hear? Can you hear me now? I think the mic works. Okay, so I think one person can't hear. I hope that can be fixed, but it seems that the microphone on our side works. So, so you can see here that you can have the same pensionable remuneration for several months. If you didn't have a change in step or change in grade, and there wasn't an adjustment of pensionable remuneration from the International Civil Service Commission, it will be probably the same. So in this case, it's a very long period of 48 months of unchanged, but that can happen. So the highest pensionable remuneration of this person happens to be this last line for 48 months. So that's nearly 5 years, right? So if you go up and add enough months to get to 60 months, you'll see that the highest 36 months are within those 48 months of line 20. I'm just telling you this that you know that there is total transparency on how we calculate benefits and what we use to calculate. So here in your pension statement, you have all the information you need to do your own mini calculation if you wish. Yes, it doesn't show you reduction factors and so on because this is just the status. But our estimate tool bases all projections and calculations on this data, on the most recent data we have, which currently is up to year end 2022. So if you run an estimate today for a separation in 2024, we are using the data that we have for your pensionable remuneration, for example, up to year end 2022, and project that into the future. If, however, you get a promotion in 2024, or you got a promotion in 2023, that is not yet reflected. So your entitlement would actually then be higher than what the estimate tool can provide you. But it is close to what you will get. I hope that makes sense. So that's the pension statement. Again, if you haven't ever looked at a pension statement, this is the moment. So we are now having a break of 2 hours, I think. Yes, till 2 p.m., during which you should rest, eat, and clear your mind. I know you are now probably humming with pension, and I do hope that you can rejoin at 2 p.m. when we will go into the details of every single benefit. Pension benefits, withdrawal settlements, retirements, and survivors, and then into the separation process and into practical elements of information for future retirees. So if you can rejoin, please do so. Thank you to all the people that attended till now. We were at some point over 260, so that's not bad. Thank you to those who sat in the ice cube with us here in the room. It is cool, but it's nice to see faces and people here. So thanks for coming, and hope to see you at 2 p.m. when we will continue. Thank you to my colleagues for answering a lot of questions in the chat. So I hope everyone gets answers to all their questions. Enjoy the break and see you later.